the webinar today on restructuring your business structures for growth.
Yes, for growth and for many other things too. We'll find out a little bit more on why you should restructure, and yeah, it's really awesome to kind of be talking about this stuff, because sometimes we'll be running a business and we kind of do the same thing the whole way, and we actually don't realize that we've actually outgrown this business structure that we set up, I don't know, years ago when we first started it. So yeah, even Ben, you might have experienced it yourself, your business growing and changing structures and improving it over time as well.
Absolutely. So, yeah, no, I definitely have sort of first-hand experiences on the challenges that maybe your initial structure gives you, and you need to sort of make changes. But that's the kind of reasons why we're here today. But before we get stuck into it, I do want to run through a couple of cool things we've got coming up. One of them is with our very own Rizal Ramzan. So that is on Friday, the 18th of March. That Riz will be running through our Save Tax workshop, which is pretty cool.
Yeah.
And we'll be sharing the key strategies of how we've saved 18 million bucks in tax and counting.
And just to add that the timing is important as well. We're heading into, it's been quite quick of a year. We're heading into the end of the financial year soon, in a couple of months. So this webinar will really help you understand what you should be doing before 30th of June to legally save you some tax. So join in if you're interested.
In fact, it's a very nice segue. So we'll actually be deep diving into what we do from a tax planning perspective in our webinar after Riz's Save Tax workshop, and this will be towards the end of March, where we'll be outlining the steps we take with our clients, what we do, some of the strategies that are very relevant for this time of year, on top of, let's say, what we've got into the Save Tax workshop, which is actually quite detail heavy around the 101s of saving tax, which is business structures, asset protection, those sort of key things, and then the tax planning webinar will go into the more the more time relevant stuff coming into the end of the financial year, and what steps you need to take to make sure you're not giving tips to the tax man.
And Rose has dropped some links as well in there. If you guys can see in the chat box, that's just some links you can register for that webinar as well. So thanks, Rose. We probably should introduce the team as well, but that we'll come back to that in a sec.
Actually, if you do want to, if you're not working with us currently and you do want to have a chat to one of our team about the webinar that we've shared, or any ideas that we've done here, or just to sort of ask some questions around working with, like how we work with our clients, then you can book in for a strategy call with one of our accounting team. And we've recently put an option there to not just have a phone call, but if you would prefer, we can have a Zoom chat as that initial strategy call, which is pretty cool. Get to see you face to face, given we're working with so many business owners around Australia now. Zoom is becoming more and more the thing rather than phones, which is pretty cool. And a little bit of an intro. If you don't know me, my name is Ben Walker. I started Inspire when I was 23 years old, 23 and naive. But I'm award-winning chartered accountant. I'm 13 years accounting experience, and I co-authored a book a few years ago called Cashed Up, which outlines the 7 steps of pulling more money, time, and happiness from your business. And these are the cute people that are important to me, my family. I've got my daughter and son there, and my wife Stevie. But that's a bit of an intro to me, and our very own Rizal Ramzan, or his.
Yeah, I have a few clients here, so you might not need this part here. But for those of you who don't know me, I'm one of the associate partners here at Inspired, and I joined Inspired back in 2016 after working with some businesses internally behind the scenes. So I've had my fair share of understanding what the challenges are when you run a business, and I love just helping people traverse that environment. In 2021, what we did was to help our clients save up to $2 million in tax. and yeah, we're looking to beat that this year in the coming a few months. What am I proud about as well is that $2 million in tax that we were able to save. We also partnered with B1G1 to give away at least a day or a day of life-changing help, whether that's food, water, health, or sanitation. And throughout our whole kind of journey here, Inspire, we've been doing this year on year, and we're proud to say that we've done upwards of $18 million, 18 million days worth of impact for families in need. So, yeah, if you guys have any questions about this stuff, B1G1's an awesome organization as well. Please check them out.
Awesome. And just a quick heads up while we're doing a couple of intros. We do have, I think we've definitely got Rose, who is our awesome marketing manager, who's popping those links in the chat box at the moment, along with, I'm not supposed to be counting down again, along with Glaze and Tay, who are also in the webinar. Just keeping an eye on it. So if you see them interact, they're our team. Thanks, Rose.
Thanks, Rose.
And are here to help if you need anything. Awesome. So let's get into it. Hey?
Yeah, enough about us.
Cool. Well, how about we kick off with a bit of the old why? So why do we need to even talk about restructuring? And there's actually quite a few different reasons why a business owner might consider a change, or it might be time to change. And they're all sorts of different reasons. They're not all sort of tax driven. They're not all growth driven. It's just, we want to make sure our business structure suits our circumstances now and as best as we can into the future. So, the first point I've got there is the business owner's initial structure doesn't actually allow for the growth of the business. So you might be getting to a point where you need to bring a business partner on, or have an exit strategy, and you can't actually sell a percentage out of your, let's say you've got a discretionary trust, you can't actually sell a fixed percent to someone else out of that. So there's an example where it might not do too well. You might also need a corporate structure where you've got a trust, or your current trading entities aren't enough. You need to set up different locations around Australia, or overseas even. We've assisted clients with the Australian side of that, but just helping them sort of grow into different requirements for the business.
And kind of, if you look at that, a lot of business structures, they do evolve over time. So if you look at it on the even the kind of start of the journey, I know a lot of business owners that sometimes start as a sole trader because it's the quickest, cheapest way to start a business structure, and you go into a company or a trust. But even then, after that point, you still can restructure, or you should restructure your business as your business grows as well. And the next dot point is a good reason as well. You might start out as a like Ben mentioned before, young and naive, just alone starting the business, and now he has a family. So over time, you want to think about succession of your business as well, that intergenerational wealth, and whether or not your business structure allows that, and is it conducive to do that as well.
That's it. But even things like accessing R&D tax incentives. I kind of mentioned a few of those others. So starting a product line separate to your core business, adding locations in, if you sort of not necessarily like us as an example, where we work out of our Brisbane office with clients all around Australia, but more so if you're a very geographical based business, like let's say a physio clinic or a doctor's surgery, that sort of thing, where people come to you, and you've got multiple locations. It's often better to have those in separate entities for a number of purposes. The big one there is asset protection. Cool.
And I'd encourage anyone who's here today to think about why you're here as well. Why did you register for the webinar? When you saw the title of business restructures, there must be something that you're coming to get out of here today. Feel free to share that with us, or even just take that note down, because that it's important that we address that, and maybe ask those questions at the end. If you don't.
In fact, yeah, could we ask if you do have a reason why you're here? What are you keen to learn? Can you just pop that in the chat box, or in the Q&A? You can even send it just to panelists if you'd prefer to keep it sort of private. Just to give us that context. That'd be fantastic. So what's sort of made you come along to the webinar today? Just so we make sure we can even tailor the message to make sure we include why you're here. Sweet. I haven't seen any yet, but fire away when ready.
Yeah. I just want to kind of add some little housekeeping stuff as well. You know, when we run webinars, we like to be as hands-on and as valuable as possible. So please ask any questions, drop any notes that you have in there. We want to make sure that you walk away from here with massive amounts of value, because you are spending an hour today on a Friday to talk about business structures. Like, you know, we want to make sure you do get that value. So use that Q&A box, drop as many notes as you can.
Awesome. Well, I guess we've talked about some of the reasons why you might, but then like in terms of the like practical, what do we need to consider? You know, a lot of this is actually for us as the accountant or advisor to work through and to guide you through. But there is also implications on the business owner themselves, and I've kind of put them towards the end here. But some of the things we need to have a think about is what's the current structure versus the proposed, and what are the benefits of changing? Even things like the tax. So if you go and change your structure from one to another, even if it stays in your family group, there is usually tax implications on it, because what the ATO sees is it's still a transaction from one entity to another. So it's technically a sale in their eyes. So we do need to consider things like stamp duty and also capital gains tax. Now, the good thing about changing structures with these sort of taxes is there are concessions and exemptions and rollovers, which heavily reduce potential tax if you're doing it between two unrelated parties, like me selling to someone independently, let's say, versus me doing a restructure within my own family group. So there can be some good concessions there. We're probably not going to go too deep into the technical side of things on that stuff in this webinar, but definitely there are ways to pay low or no CGT, capital gains tax, and even full exemptions on stamp duty, depending on which state your business is in, and a few other things like in Queensland, they've recently, as of 2020 and 2021, changed some rules to allow some rollovers to take place. There's still not full exemptions like you get in New South Wales and Victoria, unfortunately, but they're better than having no rollovers. But there's still limitations on that. So I think the turnover requirement is 5 mil in revenue or less, and a few other things. But yeah, I guess that's the sort of stuff that Riz or I or the accountant who's sort of advising you through this stuff needs to consider, because you don't want to trigger a $500,000 tax bill from a restructure, and that sort of thing. So.
Yeah, and there's a lot of myth in the financial services world, and generally people throw around, oh, you shouldn't restructure, it's going to cost you a lot in tax, it's going to do that. It's not about, and we want to kind of dive a little bit deeper under that myth and just go through it. And what we've seen in our experience is that there is a lot of ways where we can reduce and minimize those taxes. It's just about thinking about it proactively. And so if you've always had a structure that you wanted to get out of, but there's always roadblocks around it, there's definitely ways that you can reduce that impact.
Yeah, perfect. And also these transactions or restructures are actually very complex, and unfortunately they're not as quick and easy as setting up a structure itself in the first place. So there are a few steps and moving parts, especially depending on the business. Like, if you're a massive manufacturing business where you've got tons of plant and equipment, you've got stock, and a big legacy there, we need like valuation. Well, actually, most of these transactions will need a valuation, but not only that, we're valuing stock and assets and IP in certain cases and that sort of thing. So there's a valuation side. There's also, we talked about tax before, but we need to have a look at your family group in terms of eligibility for those capital gains tax rollovers or exemptions, and even around the stamp duty. If, for instance, your business operates in multiple states, then you've got like state laws crossing over each other.
That's it.
And then, it's not all about accounting and structures. We do need to get the legal sorted. So, making sure you've got a formal agreement, contract of sale between whatever you're doing, whether you're transferring shares or selling the goodwill of the business from one to the other, making sure we've got the legals in place to document it.
Yeah. And I just want to zero in on the eligibility side. This is kind of real life stuff here that I want to share the experience. And I think that's where the golden nuggets are. What we found as well with eligibility, there is a bit of a kind of deadline to some of this stuff, especially if you're a fast growing business or fast growing, you have a fast growing wealth position. Because a lot of these concessions, they apply to what we call small business. And there's eligibility criteria to that. So sometimes when we, assess and advise our clients, we see that they're just on the cusp of it and we have to do it yesterday, and just get it done straight away. So it is important that if it's something, even having a plan ahead of time, just understanding that that's something that you have in your back pocket, because there will be a point where you can't apply this as well. So that's where you kind of, the myth kind of semi becomes true, where it starts becoming expensive to restructure and that sort of thing. So yeah, there is a bit that's just worth mentioning. We've seen that in real life practice.
Yeah, absolutely. There's a window of opportunity that may
Mhm.
be closing or closed, or yeah. Also, there are sort of commercial things to consider, and there's admin that the business owner or the operations team in the business need to work through. Things like changing the trading entity. If that's part of your restructure, that means a new ABN. In the past, we've seen that can actually impact on key suppliers that you've maybe got a trading history with. And you've got to sort of approach that pretty carefully. If they don't give out those, trading terms of like 30, 60-day accounts to everyone, especially new ABNs, you might need to tell the story of why you're restructuring and saying, well, hang on, this isn't a new business. We're actually just changing entities. So, that's something to keep in mind, especially the bigger suppliers, like the multinational guys might not just instantly go, oh yeah, that's fine, like the local suppliers will. So yeah, just sort of flagging that. Moving employees over to the new entity, that's new contracts, that's acknowledging leave balances in the prior entity, all that sort of stuff. New bank account, or bank accounts, multiple. That's, there's half a day gone. You know what I mean? Like you go down to the bank with your pack, you got to do the ID process, set up the accounts. It's not a simple thing there. And then all your direct debits and merchant facilities like Stripe and however you take payment from customers, your invoice templates. Like there are things that need to change. And even this last one here, running multiple accounting files, usually we sort of want to just have only one financial year where they overlap. Like let's say we do a transaction date, at the end of March, let's say, we'll have 9 months of the financial year in the first entity and 3 in the other. But we want to wrap up that old entity, so there's no accounting fees ongoing for that, and admin fees for the next financial year in it unnecessarily.
Yeah.
So yeah, just want to flag that it just doesn't happen by itself.
And that's exactly right. There's a bit of a commitment that you need to go through for that process. And the key word there, or key phrase there, is depending on the restructure. A lot of the stuff that we're talking about here is when you change business structures where your trading entity is in. There's some restructures where you don't do that, and we'll run through that today. But this is where we need to understand that when you restructure, you're actually moving your business into a new home, essentially, and you need to do all those things like you would do if you did move a house, change the addresses, do all that stuff, connect the power, do the internet. So there will be a little bit of that effort, but it's all about cost benefit, including this kind of stuff, like the challenges we see. So the benefit should be massive enough for it to be a no-brainer, and you would go through that.
That's it. All righty. Well, we've actually got sort of 5 case studies that Riz and I are going to share now. And when we do restructures for clients, sometimes it will actually, like we're going to be, in each case study, we're kind of highlighting 1, maybe 2 key features. But sometimes in a restructure, we actually incorporate maybe 3 or 4 of the case studies we're going to show you in one transaction. So it doesn't have to be siloed like we're going to show you, but just to sort of keep it really simple, to sort of show you that some of the benefits, we're going to just go through one by one and show, the different sort of outcomes that it can give you. So I might kick off, Riz, and then you do the next, and we'll
go for it.
Alternate.
Let's go.
Alrighty. Well, the one of the first ones is restructuring to allow investment in your business. Now, what I'm meaning by there is equity investment rather than someone lending you some money. But if we have a look on the left-hand side, we've got the current structure. Now, in this example, I've given a discretionary trust. a discretionary trust is a great structure. In fact, we set up a lot of our clients initially with this structure, and it suits someone until for ages. It can suit them until they need to get investment from an equity perspective in their business, because the thing with a discretionary trust is it cannot you cannot sell a fixed percent in a discretionary trust to someone else. It's in the name. It's discretionary of who gets the profit at the end of the year, and they're great for family run businesses where the profit stays in that family group. So what we do in this case, if someone needs to get investment in, is we've got options whether we roll it from a discretionary trust into a unit trust, which is the one on the left here, or a company on the right-hand side. Now, in terms of the way we draw structures, I might just flag that as well. So we draw trusts as squares at Inspire and triangles are companies. So it's got a triangle on top of the unit trust. It actually means that's just a trustee company. If you've ever seen us draw diagrams and stuff in other workshops, webinars, or even stuff we've done one-on-one with you. But the benefit of a unit trust or a company is that it does allow a fixed percentage ownership. So that's the idea of why we'd go from this one to this one, to allow a business partner or an employee to buy in, whatever you want to do from that perspective. If you've currently got a discretionary trust, and that can't happen.
And some kind of practical scenarios in where this might happen is, yes, you might sell a part of the business, but you might not have a ready buyer right now, but your business is at that point where in the next couple of years you want to be selling it. So you can restructure now. Again, timing is so important with some of this stuff. It does have a bit of lead time and effort, like I said before. So you want to be planning ahead as well. So even if you're like, oh yeah, my trust is good right now, but if you have that exit plan in mind and you're running through a discretionary trust, having a plan ahead of time will essentially give you some milestones and goals to work towards in terms of selling. And we've seen in the past, we've helped the client through, but we've seen where they've called us up and you go, Chris, I've got a buyer. It's an amazing opportunity, but I'm in a discretionary trust. It starts becoming a little bit harder to sell the business because they wanted to sell a part of it, not all of it. And you have the propensity to lose that deal sometimes, depending on your structure. Some buyers do not want to buy just assets; they want to buy the whole company. Yeah, so planning that ahead is super important.
Cool. All righty. Case study number 2.
Yeah, so this is I'm going to use a tech company as an example. R&D stands for research and development, and what we mean by allow for R&D, it's not that you can't do research and development in a trading trust. This is what we're saying here is that when you want to apply for a research and development grant that's available by the federal government, the ATO gives you some money, a percentage of your costs for research and development gets reimbursed. The grant is only available to companies, so you can almost add this case study to grants in general. There are certain grants that we've seen, especially in the last 2 years, where, oh, sorry, you're a trading trust. Well, you're not eligible for that because you're not a corporation. So we can kind of expand this definition or this case study into those areas as well. Essentially, what we do is it's similar to the previous one. We take a trading trust, not eligible for R&D concessions. And what we do then, we restructure that. Now, the proposed restructure on the kind of left-hand side there says that there's a trust plus R&D company. That means that you still can trade in a trust, but we might want to set up a separate company where this is where you invest the money, where the research and development happens. So that company itself can be, it's almost a double use there, where you can claim the grants, but also, guess what? Your IP also sits in there as well, which will be a valuable asset. So I use an example of a tech company. Let's say they're building a software service that they're going to license out to many different business owners out there. They want to build this software. You don't want to build it through the trust, although they might be running a business through the trust right now. Do it in the company, and you can restructure that as well. Now, sometimes some of those investments or the R&D cost has already started. This is where we need to actually sell essentially that IP over to the R&D company here. So that's kind of option one. Option two is totally just restructuring the whole thing. So you can have everything under one roof. So you move your business and also your research development on the right-hand side there. So everything kind of sits in the company, nice and snug. And there's many reasons why you would do one or the other, but essentially having a company has some legitimate reasons. So you might start as a trading trust before, and then you're about to do some amazing innovation and you hit a roadblock. This is the time where you need to restructure.
Beautiful. All right. Case study number 3, restructuring to allow family succession. All righty. So we see this one where we've got, let's say, the founders of the business are the parents or the grandparents, so to speak, and they're wanting to step back out of the business and hand over the running of it and the operational and the benefits of it to the next generation. And so what we do there is we have a look at, usually it's sort of either it's run out of a trust with the parents controlling it, or it's owned by the parents' trust, whether the shares in the trading company are held in the trust. And we want to pass that control over, because technically the kids are likely going to be beneficiaries of that trust anyway, but it's the control piece. It's the sort of clean slate. We want to hand it down, hand it over. Now, the benefit, especially of a sort of longer term family run business, is that often the sale to the next generation is likely going to be either no CGT, no capital gains tax, or low CGT, which is very, very cool. And then the new owner, the next generation, will actually have a cost base to the business. So let's say the transaction happened where parents sold it to the kids for $2 million. The kids' cost, if they end up selling it down the track, is $2 million. So if they end up selling it for $3 million, they only pay tax on the $1 million difference, which is pretty cool, rather than them paying tax on the full $3 million if they were just to take over the existing structure and run with it. So that can be very beneficial. What else? I guess what structure we would use for the new structure very much depends on what the business does, what it looks like, what sort of other benefits the second generation, so to speak, what they want. And again, this is an example where we would regularly include a number of the other case studies and package it all up so we get like a huge restructure benefit. And then this sort of takes us with that business into the future to allow for whatever possibility, whether it's selling apart, doing R&D, having your actually. I'll give away a few more of the case studies, but anyway, there's no set structure that it needs to turn into, but the goal here is that the control is actually passing to the next generation.
Yeah, and I might just add there, Ben, the cool thing about this is that it means your business has lasted a long time for you to be able to pass that. So it is quite a proud moment for a lot of business owners, when especially they have the prince or princess of the family who's going to take over the crown from the king and queen, and it's really cool to see that happen in general. But most of the time they just don't know. They just don't know how they've been running it this whole time. How do we actually pass the control over? It starts getting really interesting when let's say there's many siblings in the family, but only one of them is the prince or princess. And in the case that they pass or they retire, they want to make sure that the succession of that business falls to the person who actually knows what to do with the business. So not all 5 siblings should get a piece of the business. They want it to still run, but not be sold or split up. They still want it to generate income, but they want it to pass to one specific son or daughter. Now, in that case, it becomes really interesting because what structure, it depends on what the business commercial outcome is. But there is ways in which you can do it either now or later, which might not cost any tax at all as well. But the idea here is that if you're in a position of, okay, that's exactly where I am. I have a son or daughter that works as the 2IC in the company. I'm about to take a step back. So some people already do take the step back, but if you look at the trustee and the company, they're still the director and the shareholder, and they still own the business. When you pass, that's where you have to think. and I don't like talking about that, but that's something we have to talk about. But if you do pass, where does that actually go? So business succession is a it's a big reason as well for restructure as well.
Mm. And it's usually done hand in hand with, larger estate planning for the family itself. So what we'd want to have a look at around the same time as we do a restructure like this is have a look at the parents' wills and estate planning documents, and even the kids as well, to make sure that they're aligned. We've got as Riz said, we've got the person who, the child who is best next running the business, they end up with the control. And we can still have the value of the business split between all 5 siblings in Riz's case. So like we can separate that out. So just definitely a good time to consider the old estate planning as well.
Mm-hmm. Absolutely. And sometimes certain structures, it's a little bit harder to do that. It's a little bit harder in certain structures compared to different structures. So it depends on how it is set up. So we can go through a million cases here, but this is where if you're already starting a business, some people have the opportunity to actually set it up right from the beginning, rather than later down the track as well.
That's it. Awesome. I think this is you.
Yeah, and this is I like this one because, again, it's exciting whenever we see restructures like this. This is essentially when we want to add a new product or a new location. And an example I would think in my head is a business that started with, let's say, one income line, let's say a IT business that only does servicing. So you only service laptops and phones and computers. And then suddenly they go into consulting, or infrastructure consulting and cyber security and, more services. Now you can see that there are 2 different types of businesses. Although they are IT, they're very different. The risk profile of each business is different. I would even argue maybe the insurance is different. One's a goods business, and it's service, but you have goods as well, like spare parts and things like that. And one is mainly just service. So when you start going into that, that's very natural. Your business starts growing in income stream or different services. And what you want to consider as well is whether or not they should be sitting in the same house or the same home, i.e. the same structure. I've seen many times where a risky business sitting in the same structure as a kind of cash cow that's making a lot of money, because it's so risky, it might one day be a nice target for a creditor to come after, and then it could pull down the other business as well. So if that's there's a stark difference in your businesses, splitting them up is a great option. So whether or not you trade through a single trust or a single company in this situation, we normally propose to split that up whether into multiple trusts or multiple companies. That applies the same as location. Easiest one is a gym, right? Like, you start with 1 gym, 2 gyms, 3, 4, 5, 6. Suddenly you have 10 gyms. If all 10 of them with 10 different leases, which is a big risk, some of them might be on a 5-year lease, some of them might be on an 8-year lease. Really good deals on one, really bad deals on one. Wherever the locations are, you have different risk profiles. So you want to be splitting them up into different companies. And this is an asset protection strategy to keep the other business essentially quarantined away from the risky businesses. Now, there is, again, we usually overlay this with other strategies or other case study you'll see today. But there is a way where you can also control all of them together under what we call a holding company as well. I might be giving this away a little bit. Hey, sorry. But yeah, there's, because the minute people think of this, go, Riz, I don't want, this many companies with this many, and who's going to control all of them? Am I the shareholder each one of them? There's a way that you can consolidate the corporate structure as well.
Absolutely. All righty. And nice lead into the final case study here, which is, taking a simple structure like a single company as a trading entity and turning it into one that is set up for more growth. And Riz mentioned the holding company idea, which down the bottom here, we've got this holding company, which actually 100% owns all the other entities. So let's say trading company. And even if we use the gym example, this is gym number 1, we've got gym number 2, 3, 4, 5, 6, up to 10. We can even separate the IP and assets of the the business into its own thing, R&D, whatever it is. So you've got, multiple entities all owned by this one holding company, which, again, this might actually, it serves a few different purposes. So it does do that asset protection approach where we've got multiple entities for risk and asset protection, owned by a single holding company. But also, if you have investors that want to buy in, but let's say you only want to sell them a share in one gym, not the whole lot, we can do this with this structure. Similarly, if you want to sell all the operating gyms and retain the IP and assets and start a franchise, we can do that with this structure. Like, there's so many opportunities here. That it is pretty cool. So this one's, I think, ideal for a relatively mature business or a scaling business. Like, I wouldn't sort of suggest something like this for someone who's just starting up and might be turning over a couple of $100,000 at the start. But definitely this is one that is sort of phase 2 or 3 of the business uses something like this to take them to the next level.
Yeah, and it's cost benefit, right? Like everything that you do when you add more entities, there's always going to be more costs. There's going to be more accounting costs, admin costs, ASIC fees, CRM systems. So there's always going to be more costs. So cost benefit is important. If you started it out, when you're a couple $100,000 turnover, yes, you have a big vision. I'm not saying that it's not going to come true. You can always evolve. You can always change and upgrade your structure. And that's the idea of today's webinar, is really understanding that your structure that you're in, does it need upgrading? Are you at that point? And you can do it. And there's ways that you can do it where it won't cost you an arm and a leg to do it as well.
Absolutely. Cool. All righty. Riz, do you want to run us through some intangible benefits?
Yeah, and
I'm actually reading this list and I'm like, hang on, some of them are actually tangible or quantifiable, but anyway.
As accountants, we're always like, what's the number to that? We can put a number to that.
How much is peace of mind worth?
Yeah, how much is peace of mind worth? How much? What's an hourly rate sleeping at night? What is that like? So I think the idea here of just sharing this a little bit, this is from real life examples that we've seen of benefits when a business owner decides to restructure. And we've seen many reasons. For instance, you want to consolidate your brand. You have so many different entities and you want to have one holding entity that, you operate under, and that's what you want to be known as. And you might see this in real life where, you look at the Facebook turning into Meta. They've restructured stuff in the background as well for that to happen. And streamlining processes is another thing as well. I've seen where, using a trust structure might not be ideal because you can't really retain any profits in there. So because every trust has to distribute its profits at the end of the year, because you can't retain the profits, you can't retain, also there's no shareholders, but you can't then have a target of profit that you want to hit each year, because each year that money has to go out. So what happens then, you start going, you start treating it like your own bank account. So corporatizing a certain structure gives you a little bit of financial discipline as well, where you can actually set certain targets after tax as well. I'm not going to go into the tax side of things. Join the tax planning webinar for that one. But yeah, that's another reason as well. For instance, I've seen clients as well. I say, Riz, I've got all these structures, all this inter-entity loan balances, and it's just a little bit of a headache. How do I restructure this whole thing and start it on a clean slate? Because why? I want to get more financially disciplined. I want to clean the slate, because in a few years, I'm going to have a buyer that's going to look at my balance sheet. And when they look at my balance sheet, they don't want to be looking at 10 different entities that I own. That doesn't make sense. And it just wants to be, you just want to be really clear with what the balance sheet looks like as well. Peace of mind, clearer control. This is kind of on the family side of things, really. Clearer control. Again, in my example before, son, my real life example was a son and dad who runs a business. He's run the business since, I remember looking at a trust deed. It was old. It was an old business. And the son has come in and taken over as a CEO and director role, and the dad doesn't work anymore. But there's such a, but the dad's still the director and on paper it's still the director and business owner. Now everything still has to go through him. when it comes to signing off on stuff, but the son knows what's happening in the business. So there's very muddy control. We don't know what's happening there. And when you restructure and selling shares over and changing it into, let's say, a corporate structure, we gave them a little bit more clarity. Say, okay, cool. You've got your bit now for running the business for the last 20 years because we've restructured that. You've got paid out for that. Now the son takes over. What's cool about that was it was very arm's length between the son and the dad, where we actually paid the dad out for the business for all his hard work for the last 20 years in way of a vendor finance, which means that because that was one of his concerns. He was worried that he couldn't still live off the company. He needed the money from that company, but he couldn't live off it because the son needs to get paid from running the business now. So that was an interesting situation, that one. Peace of mind, obviously, knowing that your assets are protected is a big thing. If in my example of the gym situation, we've seen what the floods have done recently and what that could do to businesses as well. If you had some of the gyms sitting on a hill, you don't want the other gyms to be pulling that one down as well. So having that peace of mind, knowing that you're safe, again, super intangible. I like the last one the most, actually, because we have, as business owners, we dream big. We want to go hard at it and be super successful and really expand our business beyond our own imaginations. Now, there's an excitement that we see as well whenever you restructure business, and the end goal in mind is that someone's going to buy this business, and now they can. It really lights a fire in you. And you kind of go, oh my gosh, this is real. Like, I can actually sell this business now. It's not a thought that I've put on my vision board or anything like that. I've actually taken steps to do this, and there's actually a plan forward. So that's an intangible benefit I've seen in real life with real business owners. They've actually said that to me. But yeah, I'll give Ben the opportunity to run through the tangible stuff because he's an accountant.
That's it. And maybe this is another way to put tangible is quantifiable. Like we can actually work out what the dollar figure benefit is actually going to be. We can ballpark it before a client goes ahead with the transaction as well. Not all of it's known until we, lift up the rocks and have a look what's underneath, so to speak. And but we can definitely do ballparks. But some of the things are no or low capital gains tax when we use rollovers or exemptions, and that can save hundreds of thousands of dollars in tax, maybe even more. Like we've I think one of the recent ones was about 1.4 million in ballpark tax savings across all this tangible stuff. But that was one of the sort of outcomes that we had. Same with stamp duty. Again, we don't want to pay tax if we don't need to or we don't have to from a legal perspective. And so we want to make sure, are we going to be able to get a stamp duty exemption or reduction? And that might mean, as Rick said right at the start, we've got a window of opportunity in certain states where we're only going to be eligible for a certain amount of time before we're no longer if the business grows too quickly. Also resetting your cost base. I gave an example earlier. If the second generation buys it off the first gen or the founders of the business, then there's ways to lock in a new cost base for that business if the second gen was to sell it soon after or after, whenever. Division 7A management. So when we sort of transfer or sell a business from one entity to the other, the new entity kind of has to pay for that. And if it hasn't got the cash to pay for it, we can do vendor finance, which is basically the new entity owes the old owner the money. And sometimes that does help with Division 7A loans. If you know that phrase, you know it. And they can be a bit of a pain to manage from a very long-term perspective, but a restructure might actually help those in that situation considerably. Asset protection, again, like you can quantify it if you get a missile fired at you, of how much how much assets you're protected in a transaction. Access to R&D grants, again, that's easily quantifiable by what grant you get and how much it is, and then debt recycling. So another strategy we do with restructures is the new entity actually borrows money from the bank to pay out the old entity or the old owner. And they do that through accessing equity in a home or property or something like that. So what we can do is debt recycle in usually a significant way in one transaction, where we turn non-deductible debt into deductible debt through the use of that debt is because of a business purchase or a tax deductible reason. So that can also be a pretty good outcome for clients as well.
Yeah, and then with the benefits here as well, as you can see, the stamp duty and the CGT stuff, the benefits in that is, what we mean by that benefit is that if you do it, if you don't do it, obviously you don't pay any CGT, or you don't pay any stamp duty, you just keep running. And what we're kind of trying to showcase there is, but if you've already outgrown the business, or you need asset protection, you need succession planning, you need different locations for your business, there's actually a cost to your business for not doing it. Now, the benefit of doing it now rather than later, especially with some horizons that might end, is that you can do it now with no CGT or low CGTA, and stamp duty exemptions as well. So yeah, that's a massive, usually in my experience of doing this, that's a massive yes, we should do it or not. Because if it costs millions of dollars or hundreds of thousands of dollars in tax for us to do this restructure, I'll live with the pain of not being able to restructure my business, and then that sucks. So that's a massive benefit usually. And how we do that is, again, we're not going to run through the technical stuff on how to actually do it. It's a little bit too detailed for today's 1 hour webinar, but that's something that we found time and time again. There's so many different ways that you can do something that's usually overlooked, and we've spent quite amount of time studying and learning all the different strategies that's available, so we can do this in a very tax effective manner.
And yeah, but just to add to that, we might come up with maybe 3 or 4 different ways a client can restructure, and it's just working out through the options what the best outcome is for the commercial reasons, the tax reasons, whatever it is, to get the absolute best outcome. We might open up for question and answers, and while, like, if you've got some questions that have popped up, Susan, I've seen a couple of yours in the chat box that we'll get to. I just want to sort of wrap up the formal bit. If you do want to have a look at our previous webinars, or even this one, will end up on social media, on Facebook and YouTube. I think we pop them up. Then do give us a follow and a like on all the platforms, or your favorite one. And yeah, as I mentioned, we've got tons of different bits and pieces of educational content on, especially Facebook is our major platform that we use. And if you do want to talk to us about what we've talked about, the restructuring side of things, then please book in for a strategy call with one of our accounting team. And again, like, we're super excited to now offer the Zoom link, a Zoom strategy call instead of just a phone call, so we can have a chat, see you face to face, and online anyway, and go from there. Alrighty, well, we might jump into Q&A now.
And I just want to start off with look, we're in a public space. If you don't want to share details, that's okay. But if you want to share some thoughts and the idea of what you're trying to ask the question on, that might be really helpful for some people. So if you came to this webinar and you feel like, oh, yep, I've seen what they mean by restructure, but you have a specific question, this is the time. I really want to make sure that you guys get some value outside of what we've presented as well, just more value that you can get out of this.
That's it. And there's a question around the bank and setting up accounts. So with that one, a registered business name is attached to, just for sort of reading your question, it should be attached to the company name. And so if you go to the bank, I would just suggest setting up the account in the name of the company. And then, from your business perspective, you can trade as your business name to the public, because it's attached to that company. So all the customer money can be paid into your company account, and that should be pretty straightforward. Some banks are weird. They'll not understand structures. What I recommend with setting up bank accounts is actually going to the CBD branches, like the central business district branches in your state, like the main one. And then usually what you'll do there is get more more people who are familiar with the business side of things. So trusts and companies are a lot more common than, and I've experienced this personally, than, going to a bank that's 20, 30, 40 minutes from the city, where they'll get, 97% of the accounts they set up are personal ones, and they don't often see the business stuff.
Yeah.
So so try a Citibank, or like a city-based bank, or just try a different bank.
That's true. And no, changing a business name does not mean restructure. And that's the kind of basic of it. Is changing a business name is like almost like painting your house a new color. It's still the same house, it's a different color. Whereas restructuring is moving into a new house. You're actually leaving that address. So no, the banks shouldn't have any confusion in that. Look
Or a
at
turtle leaving its shell.
a turtle leaving. Oh, hermit crab.
Do they do that?
No, I don't think turtles do.
They don't do that. Whoops.
I think hermit crabs do. Oh man, that's hilarious.
Hermit crabs.
Oh, I'm just imagining a turtle without a shell. That's why I'm laughing so hard.
Yeah.
And I just want to answer Sally, Sam. It's not a really question, but rather what you're experiencing right now, Sally, is you've mentioned that you have a trust, and you seem to not be using the trust. And we've heard this many times from some of our prospective clients that come through the door. Say, I have a trust, I don't know what it's for. And more often than not, there is a reason. Maybe it wasn't thoroughly explained, or that you don't need that trust anymore. So I've seen situations where the trust is not set up correctly. We wouldn't want to use it anyways. You want to shut it down and start a different one. I've seen situations where the trust is there, it's just that it hasn't been used at all. And when we say used, how it's used, more often than not, it actually depends on your accountant. It's actually not you that uses the trust. If it's an asset trust that owns investments, then obviously you use it. But if there's a trust that you don't use it, you don't know why it's there. Usually it's a holding trust. It holds some things like shares and things like that. Now, if you don't know why, Sally, I think we have a catch up too after this, which is really cool. We can run through that. But generally speaking, if you don't know why you have a trust, I'm going to put confidence here that there is a reason for it. It's just whether or not it's being used. Now, one of the main reasons it can be there for is, again, asset protection and tax planning purposes. So that should, whether or not it's being used, should be explained to you every time your business tax return or your group tax return is done, and or even just before, during the tax planning season, where leading up to 30th of June, they would explain, hey, we might issue some dividends to your family trust, which holds the shares in this company, and that might distribute on to your family group. So yeah, it's a weird one if it's never been used, but we can definitely we need more information on why, and we might do that on offline, Sally.
Awesome. Alrighty. Well, yeah, we do have an opportunity for some questions if they come through, but we can't see any others at the moment.
Yeah, I mean, like, we have an opportunity also. What if everyone wants to pop in more questions? We have an opportunity to share some kind of real life examples. I think with the restructure side of things, we've seen, like in my example, the dad and the son. Ben, you have a business succession thing going on right now, and on the Division 7A management side, that's actually quite an interesting one as well. And we've seen examples where you're able to actually use the loan that you borrowed from this company in the sale of your business as well. So in short, because I don't want to get too technical, in short, if you've borrowed money from your company in the past, in a way, you've drawn down the equity on that business for that time. So think of it as a house as well. If you've drawn down the equity on the home, you've drawn down on it. And if you sell the house in the future, you're not going to get that money, because you owe the banks that money now. It's a similar situation here where in the event of a restructure, the side effect of it sometimes is that your Division 7A loans get managed or get paid back because you've refinanced that loan essentially into another asset. So if you have Division 7A problems and you want to discover how a restructure can help. And it's not usually the only purpose. Usually, like I said, we don't silo it like that. Might be actually other commercial reasons as well why you should restructure. That could be a tipping point for you guys as well, just to reach out and make sure that there's a strategy around it. Especially if your Division 7A loans have grown over time and it's not going down, that's not a great sign. But if it's grown over time and it's getting out of control, there's ways that you can essentially refinance it.
Beautiful. All righty. Well, we might wrap up there. And yeah, no, that was good. Thanks for everyone who's joined. And yeah, as I mentioned a couple of times, feel free to reach out to our team for a strategy call, or even Riz or I personally. Feel free to do that. Awesome. To talk more about what we've covered.
Awesome. Thanks, everyone. Have a great weekend ahead.
Brilliant. All righty.
Thanks, John.